Today I am going to discuss about accounting equations and its formation. Let's look at the main equation. Assets equals equity plus liabilities. So in order to explain the main equation, I will break down this equation into two parts. First one is assets equals equity, and the second part is asset equals equity plus liabilities. Let me move on to a concept called entity concept. What do you mean by entity concept? Entity concept means business and the owners are treated as two separate entities. So therefore, only the business related transactions are recorded in the books of the business. For example, let's say the owner has invested $100,000 in the business. When the owner invests money in the business, what is the impact? So what are the two impacts? First one is business receives cash. First thing is business receives cash. At the same time, business has to pay back the cash to its owner. So business receives cash, at the same time it has to pay back the money to the owner. The business owns cash and business owes cash to its owner. So when the business receives cash, business owns an asset. At the same time, when the business has to pay back to its owner, it creates a liability. So see the dual impact. It affects on the one side the asset, on the other side liability. So therefore, if you look at this transaction from the point of view of the business, there will be dual impact. Now let's look at the equation. When business receives cash, $100,000, the cash of the business will increase by 100,000. And also it creates a liability. It owes a liability towards the owner. The liability towards the owner is known as the equity. So therefore, the equity balance also increases. Owner's equity by 100,000. So thereby, at any given time, the asset will be equal to the equity. Now let's look at the second part, assets equals equity plus liabilities. For that, let's assume the business has obtained a bank loan, let's say $50,000. So even here there will be dual impact from the business point of view. So what is the dual impact? When business receives money from the bank, the cash balance will increase, or the asset of the business, the cash balance will increase by 50,000. And also from business point of view, it owes a liability towards the bank. So therefore it creates a liability towards the bank, 50,000. Cash balance will increase by 50,000, which is equal to the liability, the bank loan will also increase by 50,000. So therefore you can see your assets 50,000 and liability 50,000. So at any given time, your asset will be equal to equity plus liability. So in this scenario, the first transaction, owner has invested 100,000, the cash increased by 100,000 and owner's equity increased by 100,000. In the second scenario, the business has obtained a bank loan worth 50,000. So by 50,000, the cash balance increased and also the liability to the bank increase 50,000. If you summarize this, the total cash balance will be under assets 100,000 plus 50,000. Cash balance will be 150,000, which is equal to, you have the equity balance $100,000 plus your liability, the bank loan, 50,000. So your total assets value 150,000 is equal to equity 100,000 plus bank loan 50,000. So at any given time, your balance sheet equation will balance.